Welcome to Investors Insights. Our topic today is winning with interest rates, ? I'm excited about this topic because we've got clients talking to us about what current interest rates are doing, not only in terms of loans, but also in terms of investments, money markets, CDs, government bonds, the list goes on. And so we had a great conversation and research report this morning. I thoroughly enjoyed my colleagues Bobby Norman and Ty Miller as we went back and forth about issues and diversification and the importance of where we are in the interest rate cycle. So with that, Bobby, a lot of people are saying, well, with all the volatility going on and other things, why don't we just put everything in something that's paying us a fixed rate? So you did some great research just to show the importance of diversification over the long game, over the long term. So talk about that.
Yeah, as Greg mentioned, we continue to have conversations with investors who are interested in current yields, either from bonds or savings accounts. So I want to give an update on where yields stand and also talk about real rates of return. And real rates, that includes inflation. So bonds have always been obviously an important part of a diversified strategy. But I want to point out that when looking at bond returns and more specifically yields, it's important for investors to look at real rates of return that includes taking current yields and subtracting out the current inflation rate. So I want to share this chart that shows yields, inflation, and real rates of return going back to 2008. Unfortunately, for Treasury bond investors, higher interest rates have been unable to overcome the impact of inflation on real yields over the past several years. While yields are they're not only the aspect of bonds, they're an important part. And as this chart reveals, the real yield on a 10-year Treasury bond has been negative at the end of the last 4 consecutive years and remains negative today. However, there were 8 observations in this chart where inflation was 2% or lower. And as you can see, real yields were positive in 7 of those 8 year-end snapshots. The main point here is that while it's great to have better return on yield-oriented investments like bonds and other fixed income, we as investment managers look at total return. And right now, inflation is causing some current real rates on government bonds to be actually negative. And this is why keeping exposure to stocks is important to longer-term investors. Important fact here, over the past 30 years, the average real rate of return on a 10-year Treasury bond is 1.4%, while the average return of the S&P 500 stock index is 9.8% in that same 30-year period. So it's important to look at total real rates of return when looking at investment strategies.
Yeah, that's what I really appreciate with the conversation with Ty and you, because of the fact, one, diversification, and also at times you have to shift accordingly in the economic cycle you're in. There are times to have more on interest-bearing investments or money market and government bonds. There are other times that you need to reallocate. And that's one thing that we do here at Five Plan Partners in relation to our clients' financial blueprint. I like to point out to people, and I always pick on the 70s because inflation was really wild during the 70s, but it averaged out to around 3%. If you maintain a 3% rate, inflation rate, 3% inflation rate over a 10-year period, you lose a third of your purchasing power. That's what that is. And so what you're in essence saying, Bobby, hey, it's great to put money into some of these things temporarily, but if there's other cycles or opportunities, then that's where we at Five Plan Partners or in working with our clients can shift the money.
Yeah, absolutely.
And Ty, I really appreciate the research that you expressed this morning, that you did over the weekend in regards to interest rates, as well as corporate earnings. There's a lot of stories going on out there that the media is not highlighting. I also want to point out to people that, we have a lot of opportunities here at Five Plan Partners on where we can place money, and one of which is in money market and CDs. I've had conversations where clients have gone, oh, I didn't realize fully that your money market could have this much money in it. And I'm like, absolutely. And in addition to that, we're paying more than the current bank is paying. So keeping that in mind, Ty, just talk about your research on interest rates and then tie that into earnings, because that's not a topic of conversation right now.
Yeah, absolutely. So, kind of we've seen about the regional banking crisis and we've kind of, all seen that firsthand and what's going on. And we've talked about how yields and rapid rise in rates have affected the regional banks. But not only that, I mean, the rise of money market funds have really taken some deposits away from banks. So as you see in this chart, since the rate hike cycle started last March, bank deposits have seen about $1 trillion of outflows. So where's that money going? Well, 750 billion of it has gone to money market funds. Well, why is that? Well, money market funds, yielding just a shade under 5% roughly right now. As you see, I'm sure you've called your local bank. Their savings rates are about 1% or lower. And so, there are CD options, but money markets, kind of give you some more liquidity in that sense and allow you to be flexible to take advantage of opportunities in the market. Now, of course, their rates do go up and down where a CD locks it in. However, if you do see those rates going lower or anything like that, the flexibility to kind of jump into the market, which will kind of transition me on the next point, is beneficial. And so, talking about the market here in the first quarter, we've seen earnings at a 77% beat rate. So 94% of companies have reported earnings. The earnings season's almost done. 77 have beaten, which is a very good sign, very good strength, something we like to see. And then, kind of counterintuitive to that point is in Q3 of last year is kind of when we saw earnings top out. We're just a shade under what Q3 of last year was. However, again, while these expectations have been lowered, and I think we can all agree that, we probably had lowered expectations coming into the year with the market, a 77% beat rate on earnings is very encouraging and something that isn't in the news right now with all the talk on debt ceiling and rates, but ultimately matters a ton to stocks and where the market goes from here.
No, that's great insight. And I really appreciate you going over that because right now the news media is focusing on the debt ceiling debate, and it's an important topic, but there's also other things taking place, and also emphasizing to people too that there's a strategy here in relation to their financial blueprint and a strategy within the economic cycles and what's going on in the market. There's a time to be in money markets. There's a time to be in CDs and bonds. There's also a reason to diversify, and we apply all that here at Five Plan Partners. And folks, throughout the rest of this week and throughout the year, for that matter, we're always posting on social media, LinkedIn, Twitter, Facebook, our podcast on YouTube. We're always wanting to provide you information. In addition to that, we're very appreciative of those of you that forward this to colleagues and neighbors and friends. And also know that if you need to have a virtual meeting with us or an in-person meeting or a telephone call, we're always available. We enjoy talking about this and looking at comparisons and where we think economic cycles are going. So as we head into the Memorial Day weekend coming up, we just want you to know that we're here each and every day at Five Plan Partners, striving to see to it that your lives have a better, richer, fuller life. And we will keep you updated because we think we've got some good things going on. Take care. Thanks for taking time to join us this morning.